Hey everybody, this is Ben Kesnoka, co-founder and partner at Village Global, a network-driven venture firm. And this is our podcast, where we go deep on all things business and technology with world-leading experts.
Welcome to the AI fundraising masterclass we have here for Village Global. My name is Sam Kirschner. I'm a vice president here. We're joined by Aaron Harris of Moggy & Co. Aaron spent 7 years at Y Combinator and infamously built out their Series A program for their founders. He's since advised hundreds of A and B rounds and helped founders go on to raise more than $3 billion in funding. Today, he's going to be sharing some pro tips on fundraising in the age of AI. We'll be taking Q&A during his talk and after as well, so feel free to throw any questions that you have in during the chat throughout. I'll bring folks up to be asking questions on this. Notice that we'll have people be able to actually be on screen. If you have your video on, then we'll actually have you bring up the question yourself so you can ask it on your own. If you don't have your video on, like you're on the move or something, and your video is off, then we're not going to ask you to come up. I'm just going to ask that question for you. And with that, Aaron, we'll let you take it away.
Amazing. Thank you so much for the intro. I'm going to share my screen so you can see what I'm looking at. But before I start, two major notes about the presentation. One, as Sam mentioned, ask questions whenever they come up. The less I talk at a stretch, the happier I am, though I've been accused of enjoying the sound of my own voice. And the second thing is anything that I say in the presentation that sounds as if it's kind of black and white advice, shouldn't be treated that way. Everything here is at best a framework, a way to understand certain situations. But advice for startups, advice in general, but specifically for startups, is only useful insofar as it's directly applied to your situation, your company, your investor set, your progress, all those things. And so you always have to translate it through that lens. If you don't, you end up just making weird mistakes. So always think about it from there. Okay. Let's go to this thing. I'm going to share. I think that's the right window. All right. Okay. So Sam did a great job introducing me. The only things I'll say otherwise are I spent a long time at YC, built the Series A program, also was the first investor in Deel, in Scale, in Rappi, and a bunch of other really cool companies. And then through the Series A program that I built there, as Sam mentioned, we did about 200 Series A's and B's, including things like Retool and Modern Treasury, and a whole bunch of other companies. We raised something like $3 to $3.5 billion there. And since leaving YC and starting to build Moggy, we've been doing kind of the same thing, where we're advising founders on fundraising. We think of ourselves as fundraising strategists, which isn't a real term. We kind of just made it up, but it applies to what we do. And we've now advised 31 companies across 31 different rounds. The 32nd actually just signed a term sheet last night, which is cool. And we've raised over $1 billion with those companies. And what I've seen across all those rounds is kind of certain commonalities in terms of how fundraising works and how fundraising doesn't work. And one of the big things in fundraising is this concept of hype. Right? How do you use it? What does it mean? How does it function in a fundraise? And so today's talk is nominally about fundraising for AI, but what it's really about is hype-based fundraising. And I think hype is misunderstood, and it's treated as something bad or something like fake, but it's not. It's a tool, and it's one you should use. So we'll kind of get into a little bit of how to do that. So the first thing to understand is what hype, how it functions in the system, right? It's just a tool. And it's a tool that you can use to help you fundraise. It won't guarantee the success of your business by any measure, but it won't guarantee the success of a fundraise, right? And so you can hope that it helps you along the way. You can use it to help you through a fundraise, but even if it works to help you fundraise, it doesn't mean your business is going to succeed. Just because everyone is excited about something doesn't mean your business is going to actually work. And the reality is right now the hype, it's focused on AI. 3 years ago, it was focused on crypto. And if you want a good example of a place in which a hype cycle can supercharge a sector of the market but not guarantee success, look at how many crypto companies were able to raise massive amounts of money using hype and then had nothing afterwards. I know a number of companies that raised literally hundreds of millions of dollars, and they're sitting there years later with a massive pref stack, a crazy high price, and kind of nothing to show for it. So remember that any tool, just because you have it, doesn't mean you should use it to its kind of fullest power. The way hype cycles work is kind of fun. Basically, what happens, and we'll use this in AI, is there's some sort of big bang moment, right? A catalyst where something happens that creates hype. And for anyone building an AI company, the real moment for that is the release of ChatGPT. Now, there were AI companies before that. There were interesting things happening before that, but that's this moment where everyone all of a sudden was like, oh, holy crap, look at this thing happening. We should pay attention to it. And so the first thing that happens is some startup uses that hype to raise money. And the first company to do it was OpenAI, right? They'd raised a lot of money beforehand. They immediately started raising more money. And what happens is that VCs see the pitch. One of two things happens. Either they see the pitch and they couldn't get into the deal, or they didn't see the pitch and wish they had, or they saw it, they got excited, and they're looking for something similar because they didn't think that was the right answer. And so what they do is they go find another company and they fund something similar to the first company that got funded off the hype cycle, the company that generated the first bit of hype. But then a whole bunch of founders see VCs funding things and they're like, oh, there's money there. Either we're going to build specifically for that thing, or we're going to change our narrative structure, our story that we tell to capture some of that hype. So they start companies that then get funded more, and then the cycle just goes. And that's a flywheel, right? Because as more companies get started and they attract more funding, more VCs look at it. And then you have funds that are like, we're crypto only. No. We're AI only. We are an AI fund. We're telling it that's what we do. And now they have to fund AI companies. And so you get a cycle.
Aaron, to jump in quickly. When does it end? Like this is the hype cycle, but like, how does it end and die? Like, what does that look like?
Oh, nobody knows. In fact, and if I knew, I'd be like buying puts on various parts of the market, right? Like if you knew when a hype cycle was going to start or end, you could make infinite money because those shocks are always extreme, but you don't. And so given that you don't know when the hype cycle is going to end, you want to understand it and use it if you can, right? I'm not going to give like a kind of this religious answer of, well, hype is dirty. It is by definition, not based on reality, not based on the fundamentals. So therefore avoid it. No. Use every tool at your disposal to raise the money that you need to build the company. But, and we'll get to this, make sure you actually need the money.
Awesome. Thanks.
So before we talk really specifically about how to use hype, let's talk about how it works. Right? You got to understand the investor psychology here to understand why this stuff is happening. VCs fundamentally have their fundamental job, right? The reason they make investments is to make money, right? It's a financial firm. And the game is designed to invest in the biggest possible companies at the lowest possible price, which generally means early in the life of the company. Now, the larger the potential outcome, right, the more excited the investor is. And it creates funny things. Like if you knew that OpenAI was going to be worth $300 billion, then the $1 billion price looks reasonable. But nobody knew that. So the $1 billion price at which they raised, kind of one of their big early institutional rounds after not being a nonprofit anymore, was at $1 billion. A lot of people said, too rich. The problem is the outcomes for these things are super far into the future. And so mostly at the C, at the A, the B, investors don't have much information. They don't have much data to go on. So what they're really investing in is basically stories. And so it's your job to tell a story about how your company creates and then captures unbelievably large economic opportunities. And this is something that people miss because they tell a story about, oh, the world is going to be different in the future. We fit into it. No. You don't fit into it. You cause the phase change in the world, right? You change the way a market works. That's how you create opportunity. And what I've seen great founders do is use the story of their company to grab VC attention, right? VC attention is actually the limited commodity. If you think about the job of a VC, how it's structured, and you can talk to the Village team about this, a lot of it's focused on sourcing, right? You have to go and find the companies. Some amount is focused on evaluation of the companies, and then some amount is focused on like supporting those companies over time. The limiting factor isn't actually money, right? The big firms have near infinite money to fund whatever they want. Not everyone does, fine, I'm generalizing. But the thing they can't actually create more of is more time in their day to look at interesting opportunities. And so you need to figure out how to grab that attention for yourself and then turn that attention into excitement. And that's hard because attention can easily flip into pessimism, which is not what you want. So the way that I think of hype in that dynamic is that hype it's like a market condition, but it's also a tool, right? It's a way to describe the state of the market. People are excited. They are hyped on something. And it's also a specific tool that founders can deploy in telling that story. When there's hype in the market, VCs become extra attentive to any company that fits the hype narrative. That's not to say they'll invest, but they have to pay attention to that thing because it's what everyone's talking about. It's all over Twitter, blogs, blah, 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 whatever. It's what everyone's talking about. It's what they're talking about in their partner meetings over dinner. That's where they want to fit. So that gets you in front of them if you fit the narrative. The next thing it does is it kind of acts like, honestly, alcohol or a drug, in that it lowers the barrier to turn attention into excitement. Right? Great investors are fundamentally optimists. They have to be, because the entire bet is, I'm betting in something tiny now that I believe is going to be gigantic in the future. That's 10 plus years away. So not only do you have to believe that the future is going to be better than the present, you have to believe that you're right about what you're betting on. But they're also extremely skeptical because they've seen so many people tell big stories and then fall flat on their faces. Right. So when that hype is running in the market, they're less likely to listen to the skeptical part of the brain. It's kind of like, bad example, but if you are out at late at night and drinking and it's 2 a.m., this is great How I Met Your Mother bit about this from a long time ago. Like, the right answer at 2 a.m. is always to go home. But sometimes you're like, no, I'm going to keep going. That's kind of what hype does to brains. It says, keep going at 2 a.m. Like, this thing looks better than it is. And so it can like get you through that barrier. So if you do your job well, your story will do its job faster and better. But harnessing the hype, like actually making it work, that's tricky, right? There's like a way to do that. So let's take one step back for a second, though, because I'm talking about the way to use a weapon and not when and how to use the weapon, right? The first thing to think about when you're thinking about fundraising is whether or not you actually need the money. And this is tricky in a hype cycle because in a hype cycle, everyone around you is raising money. And so you think that's the goal. But the only reason to raise money is that capital is the fundamental limit on your growth. It's not because, it's not because you can't think of another reason, like another thing to do, right? Or because it looks like fun. It's not. It really isn't. Even people that are good at it. People who actually like think of fundraising as the trophy, it's not necessarily someone's fault. It's held up by the press as the success. It's held up by, Twitter and VC. Like, everyone talks about how great it is to raise money. It's because it's the only thing we get to talk about between the time you start and the time you IPO, right? It's the marker that, hey, you're onto something. And so we're humans. We need something to talk about. So we do. The problem is that people who believe that too much, founders who believe that, if they are also good at raising money, the thing they end up being best at is incinerating money. Because if you think that fundraising is the goal, you're good at fundraising, your incentive is to burn money so that you can raise more money, because then you get to put another point on the board, which ignores the whole point, which is terminal value. Right? You care about what the thing is worth at the end state when either you exit or IPO or something. It's not that you don't care. The things along the way matter less. So if capital is the limit on your growth, it means you need to hire more people to expand, right? You're growing too quickly. Or OpenAI is poaching all of your best engineers by offering them more money. So you need to pay higher salaries, or you need to buy GPUs. Those are all reasons to raise money, right? Those are because capital is specifically the limit on your growth. Now, I get it. There's a line out there that you should raise money when you can, right? Sure, but it's tautological. It's true because it's true. If you couldn't raise money, you wouldn't be able to raise money. Now, there are people who took this to the extreme, who said, oh, well, it's easy to raise money right now. There's hype, whatever. I can raise money, so I'm going to raise a whole lot. I know a lot of companies, a lot of founders who did that in 21 and are now effectively in zombie companies with gigantic stacks of money in the bank and no revenue, or basically no revenue, and huge prices that they can't get out from under. And they feel trapped. Their investors feel trapped. It's this weird Mexican standoff at that point, where the founder doesn't feel like they can leave because they raised all this money and made promises. The VCs can't say, hey, why don't we call quits? Because then they'd be, giving up too soon. And so there's this fundamental problem. It's a weird problem. But I'm sure we all know people who are kind of in that. So make sure you have a reason to raise money before you do.
Aaron, just a quick question on that. a lot of people are like, should we be raising these big AI rounds? Like if you can, people are kind of like, let's raise more. That's a common thing that we see.
Yep.
We as investors, it's our incentive to get them to raise less because that usually means also a lower valuation. So no one trusts our opinion when we tell them, hey, you shouldn't raise these big AI rounds, right?
Yeah.
I guess how do you think about that? Like, how do you think about right sizing for these founders? Because that's something they're asking themselves, which is like, should I just raise as much as I can, or should I actually try and right size this? Is it about the partner? Like how do they actually make that decision?
It's so hard. Because if you're in the fortunate enough situation where you have multiple people offering you money and they keep offering you more, it's very easy to say, listen, just take a little more money. It's a safety measure, or it's effectively for, I think this is why you need someone who is not incentivized purely by the amount of money that you raised, who you can trust in the situation. I'm talking my book. Like, this is why I do what I do. Mm-hmm. Someone you can talk to about, hey, what happens if we raise too much? Where does this go? And really try to think about the framing of terminal value and not value of this current round. That's important. There is a fundamental difference in expectations around your business if you raise 30 at 150 or 10 at 50 for what the next round does. The amount of you have to accomplish, right? The hurdles you have to get through, the types of funds. By the way, raising more money, if you're setting out to raise lots and lots of money, remember that if you're trying to raise a giant round, there are fewer investors who can do that round. And there are fewer partners at those funds capable of leading that round because of the amount of political capital one is required to spend. So you make your process harder. One of our companies recently did a big round, and they were in the process of selecting the lead, and someone came in and offered them 30% higher. And this is from like a $300 to $400 million valuation and more money, because they wanted to win. And the founder said no. And that other investor was a great investor for what it's worth. But the founder is experienced and knew from experience how hard it is, even at the 300, to do the things they said they were going to do. At 400, it just gets that much harder. But it's a field. There's no science here of, oh, this is the exact right number for your business. You have to think about it and think about who's going to be on the other side of the table and what their incentives are. What's it going to take to get them excited over time, and where do you have to be?
Yeah.
It's hard.
And I think one thing people don't think a lot about here is like what needs to be true for you to raise your next round. That's the thing I always challenge founders on, which is like, you can raise at a high valuation and raise a lot of money, but then you're making it that much harder in terms of the signposts that you need to go hit, right? Milestones that you need to get to. So, and it is hard. It's hard to know, and it's very, very company specific, but thanks for the answer. That was good.
That's right. And I think, for me, this is like that thing I was saying about the frameworks are interesting. It's the specifics that matter. Every single one of these dynamics is different. Sometimes it is appropriate to double the size of your round and raise the valuation, and sometimes it's not. Just looking at some of the questions, David, you asked a framework for thinking about valuation in the context of hype. So rule of thumb, the amount of money you need is equal to about 20% of your company if you're raising an A. A B, it's probably 15 to 20%. Seeds are kind of all over the place these days. Hype, the way those numbers change is if you have more competition for the round, dilution goes down. If you have less competition, dilution goes up. So what hype should do is it should give you the ability to reduce the dilution in the round by some amount, but you can't really counterfactually test this, so you don't 100% know. The challenge there is, again, to what Sam was just saying, not over optimizing on dilution in any given round. I've seen a lot of founders do something that I think is totally batshit, which is they raise a pre-seed, a seed plus an extension, and then all of a sudden at the A, like, no, we only want 18.5% dilution. Not looking at the fact that they took 50% dilution before the A because they weren't counting what safes do. Right. So if y'all are in the position of, still in your safe seed phase, be really careful about your safe dilution. Most, honestly, like in many cases, the law firms don't even know how to do the calculation because it's complicated and there's actually like recursion going on in the calculation because of post-money and pre-money. But please, please, please don't destroy yourself on dilution on your seed and then all of a sudden at the A get really precious about a point here, a point there. Think about what it's going to take. Here's the fun thing. Think about how much money you're going to need, not just in this round, but between now and 5 years from now, between now and IPO. Are you a business that needs $100 million to get to $1 billion in ARR, or a business that needs billions of dollars? And think about that. And that's hard, but think about that as you're thinking about all this stuff. All right, Sasha, what about the idea of raising more to hedge against an economic downturn and difficult raising climate in the future? I mean, again, if you are a super gifted macro economist who has an unfair advantage in seeing into the future, cool. Like maybe this is a valid argument, but you don't know when the market's going to turn or where it's going to turn. And I wrote an essay for the Information, like probably just after ChatGPT came out, where everyone was super bearish on the entire. Everything was terrible. Markets were crashed. Everything was garbage. And I wrote a thing basically saying, listen, I think that basically ChatGPT is the thing that the entire VC industry needs to give itself hope. And like this is going to lead to a wave of investing. I don't know where it's going to go, but like this is going to be an upturn. I got that right. What I didn't do was go in and buy like reams of NVIDIA stock and power providers and things like that. But that was the point at which everyone said everything was garbage. VC is dead. All these funds are going out of business, blah, blah, blah. Nope. It was the start of one of the biggest super cycles of interesting startup stuff in years. We don't know. I don't think you can plan your business based on macroeconomics. I think it generally won't hurt your specific business unless your business was going to get hurt anyway. So you could come with lots of reasons about future proofing, and you can't future proof. Andrew, have I noticed a difference in raising capital for AI given its speed of change relative to other historical nascent technologies? Look, certainly the sums going into the foundational model companies is unprecedented. I don't think we've ever seen anything like this. But it's actually kind of hard to disaggregate the degree to which that is a function of the companies and their capital needs from the way in which venture has structurally changed over the last couple of years. Right? There were no entities capable of giving a company billions of dollars 10 years ago, except for sovereign wealth funds that weren't participating in this stuff. And so there's definitely like this, what is it? Almost symbiotic relationship between the professionalization and growth of venture as an industry and the scale and the capital requirements of the businesses. Because here's the really funny thing. I would argue that outside of the foundational model companies, a lot of the AI companies raising giant amounts of money are being really, 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 really dumb by raising so much money because they're so capitally efficient. If you could get to $30 million in ARR without raising anything, or if you could mid-journey it, but then you're raising 50 or 100 or $200 million because someone convinced you to take it, there's an interesting fundamental question about the business here. How much of it is the need of the business and how much of it is the need of the investment ecosystem to deploy money? A little bit here, a little bit there, right? And again, it's the specific situation that matters.
Awesome.
All right.
Aaron, maybe back to the presentation here.
Yeah.
And, so we can get through it and then stop screen sharing. We can jump back into the chat here.
You got it. All right. So to come back to this AI thing, for what it's worth, I actually think that the hype inside of AI and around AI, it makes a lot of sense because I do think AI is transformation, right? Now, the question is the way in which it's transformational and who's going to capture that economic value. Is it actually all going to accrue to the Microsofts and Metas of the world, or is it going to accrue to the startups or somewhere in between? We don't actually know the answer to that, but it's undeniable that there is a massive economic opportunity being generated by the rate at which AI is advancing and being deployed into new business models. So VCs are being rational in looking for gigantic things here. And the hype cycle, I think, is actually rational to some extent. It's hard to know where that goes into irrational exuberance, but the great line of markets can remain irrational longer than you can remain solvent is an important one to think about here. We don't know how big it's going to be. We don't know how long where that border is. But again, if you have it, you use it. So if you have hype, and we've actually kind of covered this a little bit, but just to kind of reemphasize it, I do think it makes sense to use hype to accelerate your fundraising if you need the money. Right? Investors clearly want to see AI companies, so you can tap into that. Investors will move faster with AI companies. You just see this in like timelines. For what it's worth, when you think about the timeline of a Series A or a Series B, the way that I think about it is the hottest of hot gets a term sheet within like 48 hours of starting a process of like first pitch. Next up, it's 1 to 2 weeks. And those are pretty freaking hot. Great processes. Beyond that, you're in like the 2 to 6 week range, and you don't really have a way to gauge how long that's going to take. And then after that, there's this kind of 6 week to 3 to 4 month period where a lot of rounds get done because the founders persevered through it and just kept going. But you start to lose an ability to have any predictive kind of foresight into that. And so the AI stuff, what I see happen is it just moves through those phases a lot more rapidly, either to crap out or to get funded. And then for sure, investors are willing to pay higher prices if they think it's interesting. And if you're going to use this, you kind of have to figure out if you have it, right? Do you have, yes, hype in the market? Fine. Do you have hype that you can use as a tool? Is a pretty important question to answer before you try. I think there are kind of two main types of AI companies generating hype. There's the core AI businesses, which are fundamentally businesses that wouldn't exist without AI. Foundational model companies are probably the best example of this. And then there's kind of applied AI, which is existing companies that are using AI to improve operations and change features, and or things that are, maybe wrappers on top of other foundational model companies. Like, sure, you could do a lot of what they were doing without that model, but it becomes a lot more efficient, a lot better, a lot more interesting thanks to the models underneath. It's important to know which of these things you fit into because it changes your story and it changes what it is that investors are looking for. If you're one of these core businesses, core AI, they're really thinking a lot about uniqueness. Again, models as a good example. It's interesting to me, and I was talking about this even before last week, where the rate at which one model company catches up with another model company is kind of wild, right? OpenAI achieves a massive breakthrough. Anthropic is there, weeks later, and then Gemini is right behind, and then Llama catches up. And then you had something like DeepSeek show up, where everyone's like, oh, whoa, maybe these models aren't as unique and defensible as we thought they were from a technical perspective. And so then what we start to think about is, okay, what's the cost to get to some level of, efficacy and value creation? And this is really wild to me, something people don't think about. One of the key advantages or one of the key moats for a lot of these companies is actually the founder's ability to raise money. That is actually kind of hard. I'm not just talking little money. I'm talking big money. Can you go up against Sam Altman, who can raise $40 billion? Not that you're in direct competition, but if you're near adjacent, if you're, again, a company, going back to this question of how much money will it take you to get to real commercialization if you need billions of dollars, you are going to get evaluated against your ability to raise billions of dollars. That's really important. It's something you need to think about and incorporate into your story. On the applied AI stuff, there's a durability question, right? Hey, this thing you sold. So a lot of what's happening, a lot of what we're seeing is companies that ramped revenue really quickly, at least in contract value, and started to deploy, but those contracts rapidly decay in usage, which implies that the contract is going to fall off at the renewal cycle. I'm hearing a lot of stories of that. And investors at the beginning of the hype cycle, they were all just like throwing money at anything that rapidly shot up in revenue. And now they're all looking to see, hey, what does 6-month usage look like? Is it real? Is it not real? We gave you a lot of money, or we want to give you a lot of money. So that happens. Then there's the unit economics question, which actually, I'm almost ready to take this one off, because at the beginning, a lot of, say, wrapper companies or vertical AI companies that are using someone else's model under the hood had real cost questions because of how much they had to pay the model providers. That seems to be going away at least a little bit. But there's still some jobs that are super computationally intensive, like PDF parsing and extraction. There was a fun article about that on Hacker News this morning or yesterday, right? About just how much that stuff can cost. So that matters. And then whether or not you're going to be steamrollered. Okay, great. You're building a coding agent. Super duper. Cursor's fantastic. Some investors will look at it and be like, but OpenAI's native code, native code building ability is going to have to approximate that or kill it eventually, in the same way that, Facebook ate its children, like Zynga, just to become more powerful over time. So you got to think of, those are the things that investors are thinking in their heads that you have to address. Now, if you can address these, then you're ready to start measuring the degree to which investors believe you are hype worthy, which you honestly need to do by talking to them. There's just a fundamental truth that look, I used to give advice to founders that if you're not fundraising, then all you're doing is building, you're not meeting with investors. I think that works for some it works for many, many companies at seed. It stops to really work at A and B. You need to understand where the market is and what the investors likely to buy your equity are thinking and how they're reacting. And you do that by having coffee with them, which sounds kind of funny. But it's a very specific type of interaction. It's a casual meeting, not with a pitch deck, where you are seeing what they're willing to do with you based on how excited they are. Right? Are they willing to spend political capital on your behalf at your request? And if they are, that's an indication of interest. Indication of interest is not, oh, hey, we'd love to meet again, or can you meet with one of my other partners? That is literally a VC's job. What you want to see is what they're willing to do for you. Weirdly, you care more about the amount of political capital they're willing to spend than how useful it is for you. Now, look, I have companies we've worked with that generated millions and millions of dollars in revenue off introductions from investors who really wanted to do the A that didn't end up getting to do the A. Great. But not necessary. And if you're building consumer products, it's kind of harder to get them to figure out how to do something for you. If you're building in the enterprise, it's very easy, or even B2B. But do your research ahead of each of these meetings to figure out what you're going to ask of them and measure what they do and put that into your kind of like fundraising model. If they are falling all over themselves to do stuff for you, then you have that hype cycle. And then you can use it, and then you work it back through the other stuff. Now, I'm not going to talk specifically today about kind of the how you use it in a fundraising process itself to run the process better, because that's a whole other like hours long conversation. But this is just kind of designed like overall, if you think about it, as just a set of frameworks to thinking about where we are in the hype cycle and how it's playing out and how you can really use it. Or at least how you can know you have it so you can start planning on how to use it into running your process. So would love to spend the rest of the time on Q&A. And obviously, if we don't get to everything, I'll just flash it up here. Just email me. Always happy to take the conversation offline. A few of you already have. So keep that coming.
Awesome. Aaron, I'm curious, what narratives are you seeing working for AI companies today? And does that change across stage? Like, are you seeing certain narratives that really resonate for people at pre-seed or seed, and then narratives that are really impactful at A or B?
Yeah. So, well, here's one that's like worked really well, and I think is fading a little bit. For a while at first launch and for a while afterwards, the easiest thing to get funded was hey, we're an AI lab out of X university. We basically all just left to do this interesting thing. And the belief for a while was that these people were this person was like N of one, right? There was no one else who could possibly build the thing that they're talking about building. Therefore, let's give them $50 million. The challenge there is it quickly became apparent that the N set was actually significantly larger. As like some of these model companies, like it was easier to catch up with them. And so what you're seeing happen is a more critical eye being applied to those teams, honestly. Now, if you are Fei Li, yes, you get all the money you need because that she is an N of one person, at least in perception. But that dynamic has I think shifted to requiring more proof. There's definitely a focus on revenue. And critically what's happening now, and I alluded to this a little bit before, what investors are looking for isn't just contracted revenue. And that worked for a while. It was just, wow, look at this contracted revenue money. Now they're looking to see how long is it from contracted revenue to live revenue? And then what does usage look like? What is adoption like? Does it sustain? Because a lot of things where, hey, we're trying this out of the innovation budget. What budget does it come from? Is it from the innovation arm or is it from a business line? And so the things that are working really well, and then, okay, so that's that stuff. Then you think about sectors. Legal tech, super hot, super duper, 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 duper hot. But now the question being asked in a lot of places is, hey, did Harvey eat it? Like, are they the dominant winner in this sector? Now maybe we don't want legal tech. And so I've talked to a bunch of legal tech companies like, hey, investors are paying a ton of attention to us and now they're not. What happened? Like, well, there's an 800-pound gorilla now. So you have to figure out the counter positioning. And so it can actually be really effective again, because for every investor that put money into Harvey, there's 5 investors that looked at it and either lost or said, this is right, but wrong. And so you kind of like find it. So again, the stuff's changing really fast Agentic was super hot, I think is still super hot, but now there's questions around whose agents are actually going to win.
At that point, I'd love to bring
Yeah.
Sasha up, who actually asked a question in the chat about this, if we can bring him on. Go ahead, Sasha.
Sasha 1 or Sasha 2? There's like
You.
I see
We
there's
got you.
another one of the things, I guess, on this point, Aaron, good to see you. One of these things
Hi, Sasha.
that I feels confusing from the outside, potentially, at least to me, is this like the on the point of like how are these like AI agents or AI like vertical AI companies framing themselves to attract some money? Because from my skeptical point of view, yes, it's quick to market. You can get this like fast acceleration.
Yes.
But it drops off. I don't see very many protectable moats there. Like as soon as one gets funded, 7 to 300 get funded right afterwards.
Yes.
So there's this competition. This other thing is like this fine. I think we're now through enough releases of Anthropic and OpenAI where like you fine tune this latest release to customize for your thing. And then the next model like obliterates all the invested effort to do that and just becomes easier. And so I guess I'm trying to think about how do I frame myself. We're not really an AI agent, but I'm trying to think about how to frame myself in the market. And then I'm also just confused. I want the opportunity to understand like what is the reason why this seems getting funded like by like 30, I saw one yesterday last week for $30 million for like a vertical AI agent that had very little traction and felt very low defensible. And so I would love your perspective on that. Does that question make sense? Yeah.
Oh, it makes perfect sense. And it is one of the fundamental questions of fundraising overall. Like you've been through a bunch of fundraising, you've raised a lot of money, you've gone through that cycle, you've seen what's real and who's wearing shorts like when the tide goes out. And I think what happens is you can't really figure out what happened in any specific fundraise, honestly, from the outside, unless you saw the story. You saw what they were pitching, how they were pitching, the framing of like, yes, what we have now is small, but here's the grand vision and here's the interesting thing that we have that nobody else knows. And sometimes investors just do dumb shit, right? Like that does happen quite a bit. But I think this is why, to me, the building in secret doesn't work so well at the A, because you kind of need a live map of where investors are getting super excited, and you have to pounce when the time is ready. And so what I've seen happen is I've seen people just like perfectly time a fundraise, right? Where they were watching the market, they were building the right thing. All the investors got super hot. They got the thing through. And then 3 days later, O3 comes out and everyone's like, wait, that just invalidated your business. And they're like, well, we have your $30 million. So hopefully we'll figure something out. But I think this, to me, there's two ways to look at that, right? One is from the direction, from the outside of, they got all that money. They're doing so great. I wish I was them. But you and I know that it can be pretty terrifying to be on the other side of that equation of having just raised a big pot of money. And all of a sudden you look down and you're Wile E. Coyote. Yeah. And the canyon floor is, a mile underneath you, like, oh, crap. And that's why I think it really comes back to this question of, do you need money? What for? Are you right-sizing it? And
do you think that the heat in the market is are you starting to see that? Like maybe 6 months ago or 9 months ago, it was like, oh my God, agents are there. And then like it wanes, or do you still think, are we plateaued or are we still in the uptick?
I think it's like sine wavy almost. It's like sine cosine happening at the same time, honestly. And so what you're seeing is certain sectors go a little bit out of favor and others get more in favor, right? So I think vertical agent stuff, tougher. Interesting applications in autonomous robotics up, right? Power center system, blah, 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 like interesting. Yeah. And so, look, I think one of the more unexplored dynamics happening right now that is a little hard for me to parse out is I actually think that the overall structure of the venture market is ill-suited to much of what the AI market needs, right? I think you either need gigantic multi-billion dollar funds, or what a lot of companies should be doing is raising $1 to $2 million early and not raising again until their revenues support like a $30 million raise or something, like something happens. And the entire regular A and B market should basically be obliterated in the sector. But it doesn't work that way. And so the money needs to find a place to go. That's a whole other thought experiment I'm running. But anyway.
Thank you.
Yeah.
Thanks. If Alex Berman is willing to come off video, I could just ask this question. for them. There we have Alex. Great. Let's bring him up.
Yeah. Hey, Aaron. So we're building a vertical AI agent for underwriting private credit transactions. And, we have a few POCs live, and we think we're getting to that A moment. And I'm curious how you'd think about the process of raising a Series A. So specifically, a bunch of us have been around the startup community for a while. Would you 3 to 5 investors we're super hooked in with and go talk to them? Or would you try to go to 20 firms and create the sort of FOMO that way?
I just posted a link to an essay I published a month ago, which is my fundamental philosophy on fundraising. I call it auction-driven fundraising. I get the only time to run the 3 to 5 investor thing is if you have a term sheet in your hand, because you've one of my favorite silly words is ensorcel. To enchant, right? If you have basically gotten an investor all the way to the point where they're going to give you a term sheet through coffee meetings, and you have that offer essentially in hand, and there's 3 to 5 other people who you can run a tight process with, great, cool. Again, it's the specifics of your situation I would want to understand before telling you to do that. Otherwise, you are running as broad a process as you can. And I understand there's lots of arguments against this. I have seen this over literally hundreds of rounds. I think I've seen more of this than just about anyone on earth. I am 95% confident that this is right in 95% of situations.
Super helpful. So maybe just question 1B on that. At YC, I assume you can put the companies in front of everyone. What does a wide net look like in your mind? Is that 30?
Series A is 40. Series A is 40 to 50, which is hard. Okay, here's a fun stat. My favorite stat of the year. We built a first-party data set recently of all the Series A's done in the last 3 years, 22, 3, and 4. There were 2,700 Series A's in the US. I think we did US, Europe, not China, not Africa, Latin America. Okay. How many funds led those rounds? You can all throw it into chat. Throw your guesses into chat. I'm going to put you on the spot, though, Alex. Pick a number.
2,700. I'm going to guess 500 funds.
Mm-hmm.
I'm going to say the big guys took a bunch and then a lot of one-offs.
Yeah, 1,700 funds.
That's helpful.
I think if we went around this entire group, we could probably name 100, maybe 120, right? So there's this massive discovery problem. There's fundamentally a transparent market problem here, or an opaque market problem, that is wild. So give me, 2 months, month and a half, 2 months, we're releasing a new tool. That is basically the thing I've always wanted, where we took that data set, and we built a discovery engine around it, where we built out data on all the rounds, on all of we're getting through all the investors. We're not through 1,700 yet. But basically what you'll do, show up, describe your business. It will spit out the 50 rounds in the last 3 years that are most similar to yours and the partners associated with those, so you can go talk to them all.
That's awesome. I actually just had someone ask me if that existed. So
it doesn't.
Top of mind.
I know that even the top multi-stages in the world, it's a spreadsheet.
Cool. Awesome.
So,
well, that's super.
I think it's gonna be cool.
Because that's actually not the direction we were going to go. So to hear that 40 is the average for a YC company is really actually a helpful data point for us.
Yeah, look, our funnel stat when I was at YC and we ran the data was it took 40 first pitches to produce one term sheet on average.
Wow.
Yeah. Look, some are going to be different. Some are going to pitch 5 and get 10, somehow get 8 term sheets. I've seen that.
And so you probably have them doing, if they're doing 40 investors, that's called a week or 2. So you're just wall to wall for a very, very short amount of time. Okay.
Yeah, it's 2 to 3 weeks with another rack of investors, honestly, sitting behind that in case you need them.
Cool.
And Aaron, tactically on that, thanks, Alex. That was a great question. How do people get in front of those folks? Okay, you have the list.
Yeah.
Even if you know there's 1,600 firms out there, do you get intros into them? Is it from your VCs? Is it from other founders? Do you cold email them? How do you think about tactically actually getting to be in front of as many people as you need to, even during these hype cycles when a company might be really exciting?
Yeah. So to me, this is why the coffee strategy is so smart, because it forces you to build that list months in advance. And then you can take the time to find your intro routes to all the investors. You're not going to find all of them, but you're going to find a lot. So that at the point where you're ready to kick off the process, it's just pushing a button and you have all the intros ready to go from your investors, from whatever. I think there's a hierarchy of intro routes. The top is angel of yours that is a founder that has made lots and lots of money for that investor. Below that is like angel of yours or friend of yours that is a recent investment that is very exciting to that fund. Below that is some mix of your great seed investor that has a strong relationship and is honest with you about that relationship. And then it kind of like goes from there. Then there's like mutual friends. There's different ways to do it. But the funny thing is it's sometimes better for you to send a well-written cold email than to go to a tertiary connection of both of you on the hopes that you know each other because LinkedIn. I asked a friend yesterday if he was connected to a person. I was trying to do a reference on LinkedIn. I saw they were connected with one of the few connections. I said, how well do you know this person? He said, I've never heard of this person in my life. My response was, LinkedIn is full of lies. So you really have to be thoughtful about this ahead of time.
Absolutely. We're right at time. So I think we'll wrap here. Thank you so much for your time, Aaron. This was awesome. If people do have questions, feel free to reach out to him. We should drop your email in the chat one more time. It's just Aaron Harris at Moggy & Co. And with that, thanks everybody for joining. Have a great day.
Thank you all.
And thanks, Aaron, for coming.
My pleasure. Aaron. Thanks for having me. Thanks for
organizing. Good to see you. Thanks, Sam.
Thanks so much for listening to the Village Global podcast. You can check us out online at villageglobal.vc. We'd love to hear from you, your feedback, your ideas, your inspirations. You can email us at hello@villageglobal.vc.